To talk to a banker in our legislative branch this morning. He would, of course, pick the Republican from Arkansas. French Hill, he of Delta Trust years ago in Arkansas. The banker, French Hill, joins us this morning. French, I think you more than anyone in Congress are qualified to talk about the contagion effect of what happened with these marketing exercises on the West Coast. There are 74 banks in Arkansas. How are they affected by SVB and the alphabet soup that gets you to FRC?
Well, Tom, it's good to be with you this morning. You know, and staying in touch with my bank commissioner in Arkansas and touching base with the industry there, our bankers have done well. They've been able to maintain and grow deposits. They had excellent earnings reports for the companies that are public. So the business seems solid there, and that's why I feel like the contagion and challenges that we've had since the first week of March have been connected to these banks with unusual business strategies.
Long ago and far away, William Isaac, Robert McTeer, and others had to deal with a multiple bank national crisis. What action would you like to see from the executive branch to assist the troubled bank?
You know, I think the Fed's taken quick action. I think they have the tools that they need to resolve the situations that we face right now, both in their temporary loan facilities, in their Section 13 powers that they have, and then the use of Dodd-Frank's powers in deposit insurance coverage if they feel like it's a systemic risk.
Congressman, we have to shift gears a little bit to the debt ceiling debate, which a lot of people in markets aren't as focused on, but will be probably in a couple months' time or possibly sooner. Kevin McCarthy, the leader of the House for Republicans, is trying to put together this Republican plan and push it through, getting votes to have this be the unified agreement at a time when a lot of people are pushing back in the Republican Party. Do you support this bill? Do you think it has what it needs to cross the line?
Lisa, I do. I think Kevin McCarthy has listened to his conference over the past 60 days and has created a consensus program where it meets his two standards. One, that we would not support a clean debt ceiling. We just don't have the support for that in our conference. And we wouldn't support a tax increase. And so he's crafted a plan that has savings of $4.8 trillion over 10 years and raises the debt ceiling until next year. I think it will pass. It could pass today. And I think he's done a good job listening to our conference. And what we need, Lisa, is for President Biden to answer Speaker McCarthy's call from February 1st. Let's meet and discuss this on a bipartisan basis.
Well, a lot of people would argue and push back, saying that basically this is a grab bag of Republican talking points sort of underneath the bill that Kevin McCarthy has put together. I mean, is it the right starting point? Do you feel like both sides, including the Republicans, are debating and arguing in good faith?
Well, look, the Senate Democrats, led by Chuck Schumer, can't pass a clean debt ceiling, and so it's to the House to lead by offering to increase the debt ceiling, but go back to some of the things we've been talking about now for 2 years, which is let's stop the pandemic level of spending. Let's go back to controlling spending. We propose a spending cap on discretionary spending, and we propose things that will help the economy grow, get people back to work, and save taxpayers money. I think it's a good list. I understand your point about what's in it, but I think it's a very good starting point, and it unifies Republicans to pass a debt ceiling increase.
French, we've aged on this. The late, great Pete Peterson, Paul Tsongas lost way too early, Sam Nunn of Georgia. I've heard it all before. When are we going to get our act together, such as a commission that will get this done, where a commission will, like, you know, Simpson Bowles, where we'll get a commission that will do the job Republicans and Democrats refuse to do?
Boy, Tom, it's such a good point, and I do agree with you, particularly on mandatory spending in our programs like Social Security, Medicare, the big programs that grow at 6% a year, sometimes 3 times the rate of growth in the economy. President Obama had that opportunity with Speaker Boehner, with Simpson Bowles, and no action took place. But when President Johnson started the Great Society programs and spent trillions, You had mandatory spending only as a third of the budget then, and obviously not a big interest cost. Now we have 2/3 of the budget is mandatory spending, and we're facing $10 trillion in interest only over the next 10 years. So I think a bipartisan commission to tackle up or down mandatory spending is critical, and I would support that.
Away from your remit, Olivier Blanchard does the economics and says we got lucky. We got a set of low interest rates, a low, sluggish regime where growth could stay above interest rates. I don't want to go into the economics right now, but basically he's suggesting the government had a gift handed to them that allowed for this debt extension over the last 10 years. Do you feel now that things have changed? Now the mathematics is different at the Congressional Budget Office?
I think so, Tom. I mean, you're facing interest costs that will exceed the annual expenditures on national defense in the coming year. And as I say, $10 trillion of interest over the next 10 years in the president's forecast. So we're talking about interest now truly crowding out spending priorities for Congress. I think that's a wake-up call for the Congress and a wake-up call to go back to debating how do we have zero deficits and how do we reform mandatory spending programs.
Hey, Congressman, I'm confused, and maybe because I'm a foreigner and have only lived here 7 or 8 years, so help me. I thought you had to raise the debt ceiling because of spending already approved by Congress. Is that not the case?
Oh, Jonathan, you're very good this morning. Yes, of course, you're raising the debt ceiling to cover spending that's already taken place, but it gives us an opportunity to have this two-way conversation between the executive branch and the legislative branch, and we've seen this all the time. This is why I think Joe Biden's a hypocrite on this issue, because he was the lead negotiator when he was vice president on increasing the debt ceiling with budget reforms. Nancy Pelosi in 2019 did the same thing to Donald Trump. Sorry, we can't raise a clean debt ceiling. We need budget reforms. So it's an opportunity for the two sides to have a conversation. That's why the debt ceiling vote is important.
I think I'd go one step further. It's a game that Congress seems to play that misleads the public. I'm not here to advocate to say that we should have massive deficits and that the debt should carry on piling up to 40, 50 trillion. Congressman, I just think it's disingenuous to sit here and say we've got a debt problem, but at the same time, we can't raise the debt limit, because ultimately, as you know, it's Congress, which you're a part of, that's already approved this spending. It doesn't matter who's in charge of Congress, you keep approving this spending. We can at the same time, can't we say that you need to raise the debt limit, but also we need to get debt under control? Can't you say both those same things simultaneously?
Well, I think I have in this interview by answering Tom's question about a commission to get the long-term drivers of debt and deficit down, and also to your point about bringing the two parties together to work on a bipartisan basis. So I take your point technically, but politicians need deadlines. They work on deadlines, and the debt ceiling is a hard deadline, and the budget 10-year forecast can be a more amorphous deadline.
Congressman, it's a conversation we'll continue having, no doubt. French Hill.
You bet,
Thank you, sir. Thank you very much. Down in Washington, D.C., Tom, this is a conversation that's ongoing, but I think the word that you heard a few times there was politics.
It's the politics of it and the failure of these commissions, not just Simpson Bowles, but there's been others in the back. My foggy brain focused on FRC can't get there right now, but we have commissioned ourselves. I'm going to give Greenspan great credit for this, of the efficacy of commissions to get things done, and that's vapored in the culture wars and the political wars of the modern day.
Clearly, the trajectory for debt growth in this country is unsustainable. I think we all understand that, but I think that it's not explained well enough by politicians in Washington that they already agreed to this spending. They already agreed to it. That's it, the bottom line.
I think it's a good time
this is just a political opportunity to have a big fight about it.
I think when you look at American debt dynamics, it's really comfortable to be a foreigner because you've probably got a clearer vision about it than we do.
Peter Chair of Academy Securities, coming up next.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
On our estimate, our forecast, headline inflation in the US is also going to re-accelerate towards 4.5% by the end of the year.
I think we end the year with inflation that's uncomfortably high, around 4%.
Basically, every traditional leading indicator of recessions is flashing red.
We're going to see a recession out front pretty soon.
I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Bloomberg Surveillance, earnings, yes, FRC, some price stability. John, how about talking about things away from those earnings stories and bank stories? Oil. Moments ago, global Brent crude under $80 a barrel. First time in a good number of days.
A break of 80, and all it takes is a break of 4% on a 2-year, and we're talking about recession in a bigger way in the United States. That happened yesterday. We're down another couple of basis points this morning, and then we turn things around a little bit. We're higher now by 4 or 5 basis points on a 2-year, back to about 3.93. Interesting to watch this one at the moment with a 2-year top, back below 4% in the last 24 hours, off the back of weaker Fed indicators and all of that good stuff. I'll say this, Neil Dutta of Renmac writing it again and talking about what's happening in housing. What's happening in housing is maybe signs that things are bottoming out, not getting worse. The home builders have been all over this. If you go and look at the chart of the home builders, and I'm going to use some of Neil's words himself, he talks about recession. If housing is up and to the right, it's hard to talk about recession in the United States of America. And that's the pushback from the more constructive view right now on the U.S. economy.
And the more constructive view was seen yesterday, Lisa, in some earnings that were really quite good. You mentioned like Frito-Lay and the rest of it. And then there's ones that were not so good. And moments ago, Norfolk Southern out here with what on first glance looks like an earnings beat, even with all the challenges they've had in Ohio.
It's a muddle, right? You can pick your narrative in data, both with respect to a weaker than expected regional Fed data, with homes that are actually still doing okay, resiliency very much, and a recovery potentially in the home building space, definitely of note. So then how do you interpret this into a Fed call? How do you interpret this into a longer-term economic call? And do you not even try, like Max Kettner, and just say, you know, you might as well buy while the music's still playing?
I'm going to go back to Neil Dutta's comments here, and I think we've got to give, you know, with all the gloom of FRC and that, to both of you. John, start, please, here on the optimistic economic story out there that does not get you to recession, or at least delays it even further.
Unemployment's still at 3.5%. It's not unusual then to have a recession after that, but that's the argument, that the labour market hasn't cracked in a major way. You know, the pushback, they'll point to jobless claims and other indicators as well. The fact that home builders are holding down, that housing indicators are recovering is somewhat encouraging. Tom, there's a massive debate out there right now, as you know.
And a polarity, and at least I'm not sure there's a gray area. I mean, there's Team A, there's Arsenal, there's Man City, and I don't think there's any, Tottenham's not in between.
It's a Rorschach test. Rorschach test, however you
pronounce
pronounce
it.
I always pronounce it somewhere differently. But basically, you can pick your narrative, right? And I would argue that a lot of people say all of the recession indicators that traditionally are flashing red ahead of some sort of downturn are flashing red.
There we go.
We heard that from Francis Donald. We've heard that from so many people. Porrick Garvey saying, if you take a look at yield curves, if you take a look at tighter lending conditions, if you take a look at contraction in certain factory indexes, this all speaks to the same narrative.
I'm going to start the data check, John. We're going to do it off of an index, and we're going to go to an equity. It is First Republic. Let me plot it, John. 825. Plunging down to a 550 level, spiking up in moments ago with some huge volatility here at 6.90, maybe 6.50.
It's all over the place.
All over.
With a lot of doubts. Some conversation this morning, our reporting, suggesting they could be looking at asset sales anywhere up to $100 billion. These are big, big numbers for this name. 690 in the pre-market, but Microsoft, the other one to watch. It's a much bigger market cap story, of course, much more important to the overall index level, much bigger weighting. Microsoft up by 8% in the pre-market, helping out this equity market more broadly on the S&P 500, on the NASDAQ, of course, much more so with a much bigger weighting there. The NASDAQ, Tom, absolutely flying, going into Meta later, Amazon tomorrow, Apple next week.
Peter Shearer, he gave the name Meta to Facebook. He's the one, he called up Zuckerberg and said, you know, I think Meta has a direct name to it. I still don't know what Meta means. Joining us now, Peter Shearer, head of Macro Strategy Academy Securities. Pull together these narratives. I mean, you and I have never seen this before. Let's start with that, but pull together the narratives that are making radio and TV listeners and viewers head spin.
I think we are on a slow bleed into the recession. It is coming. It's starting at the white collar level. I think I almost go back to the simplest thing. It's someone's expense is someone else's income. And everything I read is about people cutting expenses, which is going to hit someone's income, which is going to cause them in turn to cut their expenses. And I don't see anything switching that trajectory. I think the China reopening was a head fake. It was never really a big reopening. And to me, when OPEC Plus really cut production, they were seeing what we were already seeing. Freight was down. We're seeing shipping down. There is an economic slowdown occurring just below the surface, and it's slowly taking effect. It's going to be a grind. It's not going to be like a great financial crisis or anything. And the fact that the banks are struggling with how to keep deposits is going to hurt lending, and that's going to hurt the small business, which has been a huge driver of success in the past
So much to unpack there, Pete. So let's go with China. It's a pretty emphatic thing to say. The reopening was a head fake. Why was it a head fake?
First, they were already partly open, so it wasn't like going from 0 to 100. They were going from 60 to 80, 70 to 90, whatever that was. But also, they are focusing more and more on their own economy, right? We already have this inventory. I hesitate to say glut, but I think we have an inventory glut. We have overbuilt. We have supply chains that have stacked up. So we don't really need China's production right now. And more, how I see this world shaping is you have China, again, we've said before, aligning with the autocratic, resource-rich nations. And what we're seeing, we're talking about the shift shift from made in China to made by China. And by that, I mean China used to take U.S. products, manufacture, give them back to the U.S. companies who sold them globally. I think you're going to start to see China trying to sell Chinese products globally a little bit more and be a true competitor. I think that's going to be the scary shift over the next few years.
We can build on that later in the conversation if we have time. If the reopening in China is a head fake, what's Europe with the CAC 40 up by almost 20%, the DAX up by 17%? What would you call that?
You know, Europe to me has become a bit of a mess. They're trying to figure out, I think, where they fit in, right? Macron's approach Xi, they're figuring out how they want to deal with Ukraine. So I'm not, but the nice part is I think some of their companies were undervalued. They're mostly big global entities. So some of that catch up because they'd been behind made sense. I'm kind of very neutral to bearish on Europe. I think they've got their own set of problems. On the other hand, I'm fairly bearish to neutral globally right now.
Well, that's what I was going to say. Is it really so much better in the U.S.? One of the issues that you raised was smaller banks, regional banks, and the sort of ongoing grind that we see there. We've been talking about First Republic all morning. Is this a specific story, or does it indicate something broader that is just going to grind out throughout the year?
So I think there's two things going on. One is it's really been the shift away from this concern about losing your deposits or bankruptcy to much more, what yield am I getting on those deposits, and is that yield still functional for these banks? And then I think they've also said on Wall Street, I was trying to tell my bosses this, you know, your assets walk out the door at 5 p.m. or 6 p.m., whatever time your assets leave, it's your people. And if you start losing your people, that becomes very problematic. How do you retain those people in an environment where you're struggling?
So is that really the key issue here, that we're going to see that more broadly throughout regional banks as bigger banks try to basically parachute in, take the best talent, and then there'll just be this drip, drip, drip that will carry out and tighten credit throughout the year?
Yeah, I think it's going to make people have to come up with solutions fairly quickly, whether it's mergers, acquisitions. Again, they have some phenomenal relationships, some great business models at these places. Everyone I've talked to who ever banked with First Republic says they are phenomenal, the treatment they got. So there's value to that, and I think someone's got to capture that before those assets do walk out the door.
Let me digress. We don't need a history lesson on Milton Friedman 101. Does M2 matter? Tell us what M2 is and why people like you pay attention.
I have not been paying close attention to it lately. Again, it's been dropping off, but I think there's so many other factors.
It was all the rage 30 years ago.
It was all the rage, you know, back when we had to figure out when Alan Greenspan was carrying his briefcase in his left or right hand. They didn't tell us what they were doing. I actually thought it was easier sometimes when the Fed wasn't trying to do this forward guidance. They've gotten themselves in so much trouble, which is why I think they had to hike last time for 25 bips when they should have already been stopping before that. So I'm watching all these things, but I do think the economy is slowing down, and it's showing up in some of the M2 declines.
Are we super restrictive right now when you add in the interest rate dynamics and the greater economy dynamics, the balance sheet dynamics? Are we beyond restrictive?
I think so, and part of this, it doesn't show up, but again, people don't have car leases coming due every year, but over a year or 2 years, 3 years, everyone's going to have to reset. Corporations did a phenomenal job during COVID issuing long-dated debt at very low interest rates, but some of that starts rolling off, and it's going to take time for the 5% rates to hit the consumer. I think we're at the early stages of that, and it only gets worse. It's not like anyone's rolling their 5% to 5% right now. We're still having people rolling 3% to 6%, and that's going to weigh on this.
So part of this conversation is about vulnerable parts of the market, and I promised you a pocket of time to come back to the point you made about the Chinese consumer and Chinese companies. Let's finish there. Who's vulnerable? Is it the Teslas of this world? Is it the LVMHs of this world? Can they really go about creating something like a luxury brand to compete with the European players? An EV operator, we know lots of names over in China. Where's the competition going to be most fierce?
I think it's going to be for everyday items. So whether it's cars, dishwashers, it's not going to be our quality, but they are going to try and sell their brands. They've taken a lot of the IP. They've got the manufacturing know-how now. It's not as good as what we produce or they produce for us, but it will be cheaper, and they will aggressively market that. One of the things that really struck me on this was they just struck a deal with Brazil where they're going to make their BYD cars in Brazil. Now, part of that's for tax reasons and stuff, but that to me is just a signal that China wants to sell their things that were really only consumed by Chinese broadly.
Amazing conversation, Pete. We could have for a long, long time. Peter Cheer there of Academy Securities. A head fake. The reopening in China, Tom, a head fake.
It's a debate. I mean, it's there. I'm going to go back to, John, I know you're going to the opening at Tiffany's here on Friday. Mr. Arnaud's in town, I think, for that big event for LVMH, and he made note to me last night. He said, God, John's covering us great. He's all over that puppy. And I saw him in Celine yesterday, and the answer here is LVMH is pushing against the sheer view, and they're saying, okay, we're on the Pacific Rim. We're going into Chengdu. That's pushing against that Chinese slowdown.
I want one thing from Arnaud. One thing.
Please.
Please just buy AC Milan. You know, please. There was some talk a number of years ago that he might buy the club. I mean, if you've got a struggling football club, and Milan aren't struggling right now, but if you had a struggling club, Tom, that's the man you want to buy your club.
Qantas, can we reach out to Mr. Arnaud's team just to talk to him about AC Milan?
Can they get into sport? Can they buy AC Milan?
Yeah.
Wouldn't that be phenomenal?
Yes.
It's a luxury brand.
Yeah.
It's in a fashion
He could
capital.
take that out of petty cash.
It works perfectly. He probably could. I mean, he really could. Live from New York
He
this
brings
morning.
Zava back.
Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy has bowed to the demands of a small number of House lawmakers who had threatened to sink his debt limit bill. Overnight, he decided to make changes to the measure to try to make sure it passes this week. Tax breaks for ethanol were restored, and the bill now accelerates new work requirements for Medicaid. The U.S. and the Philippines made a show of military cooperation not far from waters in the South China Sea that are claimed by China. American and Filipino forces used live rocket fire to try to sink a decommissioned vessel 12 miles off the coast. The South China Sea has been a flashpoint between the Philippines and China. Shares of Google parent Alphabet are higher after the company reported first quarter results that beat estimates. Alphabet's cloud unit turned a profit for the first time. Meanwhile, its dominant search business weathered the economic downturn. Boeing says that later this year it plans to boost production of its cash cow jet, the 737. The company reassured investors that a recently discovered manufacturing defect won't hurt its delivery and cash flow targets. Still, Boeing notched its 7th straight money-losing quarter. And the UK has delivered a huge blow to Microsoft's proposed $69 billion takeover of game maker Activision Blizzard. Antitrust regulators have vetoed that deal. That said, it could result in higher prices, fewer choices, and less innovation for gamers in the UK. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile. I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
Revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
with tech outperforming, that could be, forward expectations and forward easing expectations coming through. If we go back to last month, some of the best days for tech were when Fed cuts as early as June were priced in. So I think that relationship between financial conditions and tech we need to look at as well.
The absolutely brilliant Jeff Yu of BNY Mellon there on tech and the relationship with financial conditions and rates right now. Equity futures on the S&P 500 positive 0.1% on the S&P. A lift here, a small one, a bigger one on the Nasdaq off the back of some big gains elsewhere. Looking at Microsoft in the pre-market higher by more than 8%. One eye elsewhere on First Republic, lower but recovering from the lows of the session. We were down by more than 20% at one point. At one point, we traded very close to 550. Yeah. The low 555. That was about 7:13 this morning, about an hour ago. Recovered since then to about 7:30. Tom, the opening bell 1 hour and 13 minutes away.
And after that, Meta earnings this afternoon. John, you and I will not be watching. Have you been to Etihad at Manchester
To the
City?
Etihad? No. I think nicknamed the Empty Hat.
Okay.
Because not many fans.
I looked it up. You and me,
Perhaps a
two
little bit
tickets.
too harsh.
Two tickets, $1,871 per seat.
Wow.
It's on the west side, or the west stand, I should say. Excuse me. It's very cool. It's like 5-6 rows up, down by one of the goals.
That's real money. That's real money.
Is that a lot for, it's
to
nothing for Taylor Swift.
To go and watch your average Premier League game. This is not an average Premier League game.
This is not an average Premier League.
Not at all.
The reason I'm doing that is
top two face-off.
We got major issues here this morning. We're going to go around the horn. That's baseball talk, John. Around the horn. Thank you. Because Lisa wants to talk about Google or Microsoft, and John's got another stock, and I want to talk with Meta, with Mandeep Singh, senior tech analyst with serious street cred with Bloomberg Intelligence. Meta, like a gazillion dollars down to $91, total crater. Why didn't you tell me to buy it at 91, popping up to a 200 level? Has Zuckerberg saved the company?
Well, clearly they're showing a lot of cost discipline, and laying off 25% has given them that boost when it comes to the operating margin. And look, everyone knows that ad dollars have dried up. The digital ad spend has gone down. These companies, even Alphabet last night, grew 3% top line. But they are showing cost discipline, similar to Meta. And I think that's what's driving a lot of expectations.
Did Mandeep get the memo that we call Alphabet Google? And I just put up the banner. For those of you on radio, I just put up the Meta banner, and I said FB. Because that's in the real world how people think about this.
Facebook still.
What is Meta?
I'm happy to call them Meta. Do you know why I like calling them Meta? They've asked us to, but ultimately, that's what embodies the failure of this company in the last 12 months. Meta. The metaverse, which is why they deserve to be called Meta. They've recovered because somehow they're going to stop spending so much money on the metaverse. Do you see the discipline around that story, the sufficient discipline to meet the mantra of the year of efficiency?
I think so. They've realized it was a bad pivot. And look, when you look at ChatGPT, clearly, this market is more established. It's organically building up. Everyone is joining that bandwagon. That didn't happen with Metaverse last year. So they made that pivot too quickly. And they're realizing they obviously spent, $10 billion on OpEx, and the user engagement never came. And they missed, with TikTok competition, clearly they were losing creators. So a lot went wrong for Meta last year. They're trying to fix a lot of that. It's mostly a cost-saving story at this point of time. But my sense is they are trying to fix their ad stack. They're doubling down on Reels, which is their video equivalent to compete with TikTok. But they're still missing that engagement because YouTube last night, they called out, their views are up 60% on Shorts, which competes with TikTok. So clearly, they have the creators, and Meta still doesn't have that organic content that they need.
How much are they relying on the U.S. banning TikTok for all their future growth?
I think that could be a big driver in terms of catalyst for top line. I think that is what they need in terms of driving the engagement back. But right now, you are in an environment where search is resilient. Social media ad pricing has come under pressure, and it will remain under pressure. And look, connected TV is the next frontier when it comes to ads, which is why YouTube is such a great asset that Alphabet has. And you're going to see them do very well over the long term.
I'm old enough to remember perhaps 3 months ago when some of these social media companies were supposedly a read on the broader economy because ad spend would reflect companies' willingness to advertise, whether they actually cared enough to spend those dollars. Has it stopped being that way, or are we still expecting some slowdown on that front?
Absolutely. I think what digital ad spending is telling you is there is a slowdown in the economy, and the software models are more resilient, which is why Microsoft grew 7% and Alphabet 3%, because software is more recurring in nature. Companies just don't get rid of their software. Digital ad spending is discretionary, but within that discretionary bucket, search is the most resilient. And Alphabet yesterday called out travel and retail being the verticals that kind of went big in terms of their ad spend.
You mentioned bandwagon. I looked up Merriam-Webster. It goes back to a phrase of 1849, which is the first time I heard the phrase nanosphere, or nanotechnology. AI. Explain to our audience why AI is not a bandwagon item.
Well, so clearly think of, what search does. It's using PageRank, and Alphabet has been successful in kind of keeping that moat because they had the best data in terms of driving that PageRank. It's not, PageRank isn't proprietary. Same thing with large language models. You're using the entire open internet to train your algorithms. Look, everyone has that, but then really you need proprietary data to differentiate your search results and how you drive engagement. And that's where Alphabet still, to me, has the best training data for these large language models. Yes, you have to mix PageRank and large language models, which is going to have an impact on their gross margin because these are expensive from a cost infrastructure perspective, but clearly I think your results are going to be more driven by how you can train your algorithms, for the large data set that's available on the open internet.
What I hear from you is that we're writing off Google too quickly, too much.
Absolutely. I think if they keep showing the cost discipline, we are setting up for a cyclical rebound, as has always been the case with Alphabet, because look, 60% of their revenue is still search, and that drives the bulk of their free cash flow. So still, to me, this is a great asset, where search drives it, and they continue to hold that share in search.
Any read across at all for the ad spend story yesterday from that name for the others like Meta, like Snap?
I think social media ad spend will still be under pressure because of the pricing aspect that I called out, and advertisers will go towards the highest ROI channels. That's why you heard, travel advertisers going to Google, because that's the highest ROI channel.
Mandeep, awesome. As always, Mandeep Singh there of Bloomberg Intelligence. You want shorts, Tom? YouTube, shorts? Doing those short little videos?
Yeah, I'm doing it with Sharp Banner.
How's that working out?
It's an interesting experiment. We're experimenting with digital, but my answer is, and I could be wrong in this, and I think I heard it from Mandeep, YouTube is different. And I don't understand why, except anecdotally in my house, that's what everybody's looking at. That's a starting point. And the other is I got a smart guy like Mandeep telling me YouTube matters. So we're experimenting with, and you're going to roll this out this year, folks. You're going to see Bloomberg surveillance with Lisa's newsletter and a real focus on how people consume the three of us on YouTube. And the shorts is sort of a teaser into that.
Well, as we know, the numbers there are pretty decent. That's for sure.
They're pretty decent, and we're evolving. We got a great team. We got Ray Schlesinger. I call him Ray YouTube. Ray YouTube's my expert on this.
Why'd you give everyone a nickname like that?
Because, Ray, Ray was there. I'm outside that bookstore where Julia Roberts fell in love with Cary Grant in London, in Notting Hill or whatever it's called. And there's Ray YouTube standing on the corner, and we're talking.
Hugh Grant. Is that who you mean? I think you do. It's a great movie. You described Notting Hill, yeah? And that was Hugh Grant.
It's not Cary Grant?
No, a different era.
Thank you.
Anyway, okay. Coming up on the Open, happy to share this with you. Bob Michael of JP Morgan Asset Management, Rick Reeder of BlackRock, Nadia Lovell of UBS, Brent Thill of Jefferies. Awesome lineup next hour on Bloomberg TV, running you through this bond market, the banking difficulties, and the success that is Microsoft in the pre-market. All of that still to come.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg surveillance, interesting earnings this week. Mandeep Singh, Lisa, I just thought was outstanding there.
Totally agree.
Meta, well, Meta this afternoon as well. We're watching the banking news as well. Futures up 9 right now. And of course, most importantly, we've got to wander out here at the 8:30 hour with economic data. It is durable data. It's also ex-aircraft with Boeing reporting today. Michael McKee with us with the data. Michael, what is ex-aircraft? What does that mean?
It means you take out Boeing, basically.
You take out
because,
Boeing, right?
Because Boeing
Does France do
costs
ex-Airbus?
a lot of money to buy a jet. Here's the numbers for the durable goods orders. They are up 3.2% after a 1% decline in the prior month of February. That is a rather amazing beat. The forecast was for just 0.7. However, I'm going to guess a certain amount of it is Boeing. Durables ex transportation is up 0.3 after a 1/10 decline in the prior month and a 1/10 forecast, a negative 0.2 forecast. So that's got to be something to do with both cars and Boeing. Now we're getting the revisions to the prior month, and the prior month was down 1.2% for durable goods orders. Capital goods orders, non-defense ex-air, that's what Tom is talking about, down 0.4 after being down 0.7. And this is the bad news part of the report because, like we say, Boeing is worth a lot of money, but the rest of the business spending numbers aren't as good. They fall. The forecast was for just a 1/10 drop. We also see a 0.4 drop in shipments, so that's going to affect the first quarter growth levels. But it does show that companies are starting to pull back, and that obviously is going to be a question for the Fed. What does this exactly mean? Does it mean that the economy is going to slow like they want, or that it's going to collapse?
Yeah. Well, look into it further, Mike. The 2-year yield moving here down 3 basis points, 393 on the, let's remember that the 2-year yield was above 4%. There's been a lot of other stuff going on, including the banking issues, but nevertheless, to see a 392 2-year yield gets my attention. And Lisa, curve inversion, I mean, there's a little less, there's some dynamics going on here that are interesting, to say the least.
Well, yeah, it kind of makes me feel the way that I've felt all week and frankly all year, which is there's something going on. I'm just not sure exactly what it is. I mean, that's exactly how it feels right now.
I'm going back. I mean, McKee's looking further into the data before we get to Dr. Bryson, and I'm looking at First Republic Bank to get a quote, which perfectly shows it's 6.92 on First Republic. Mike, this is March data, right?
This is March data.
Does this give you a better GDP number, seeing those difficult ex-aircraft revisions?
Well, it will give economists with their spreadsheets a little bit of adjustment. We also got wholesale inventories and retail inventories, which were wholesale comes in as expected, retail comes in significantly higher. So that would suggest an addition to growth. So at this point, I'm going to just guess off the top of my head a bit of a wash, but we'll let the people people who actually do this for a living come up with some good numbers. Let me just go through this quickly and tell you that non-defense aircraft and parts were up by 78.4%. Now this is a dollar value data, and that reflects the fact that Boeing had a really good month, delivered 60 aircraft during the month, and that really matters. Motor vehicles were down a tenth. Now, motor vehicles in this report are fleet sales, but that was down, so that gives you an indication of how much Boeing matters for the rest of the durable goods report.
To go back an hour, Boeing off the price of $202 yesterday, up $6 to $208 right now. A nice 3% move up on Boeing. You heard that from Lisa earlier. With futures up 10 points, nice advance off the quiet we saw an hour ago. Jay Bryson joins us. He is chief economist at Wells Fargo. Thrilled that Dr. Bryson could join us this morning. Jay Bryson, your team, your heads must be spinning. You've got an awfully good team. What is the nuance now in your guesstimate of the American economy forward?
So let's start kind of where we are right now. I mean, these numbers are interesting, and actually we published a report this morning where we brought down our GDP forecast for the first quarter significantly, and it's based on revisions that the Commerce Department has made to back the last few months of retail sales. We think tomorrow it's only going to print 0.8%, which is significantly below the consensus. So it's not contracting at this point, and I wouldn't think, as we think going forward, you're going to see that at least in the second quarter. But as we get into the third quarter, given the Fed tightening, given what we think will be some credit tightening as well out there, I think we're still looking at a modest recession starting in the second half of this year.
As all of this data comes in and trickles in, each point different from the other, each point a miss, a beat, a miss, a beat, just basically evening itself out. Are you getting any more clarity with your conviction?
Well, no, Lisa, it changes on a day-by-day basis. I guess what I would say is, if you said, what's the probability of a recession this year in your view, I would handicap it roughly at, let's call it 70% or so. I mean, a soft landing is not out of the question, but just given the fact that things are definitely appear to be slowing out there. The manufacturing sector, I think at best has stalled. Housing is contracting right now. Consumers are still hanging in there at this point, but higher interest rates are going to slow things down. If we see credit tightening on top of this because of what's happened in the banking sector recently, I think that all points to a recession. So, again, it's not a foregone conclusion, but I think it's the most credible case.
You talked about housing in there as one of the indicators that it was slowing down, and yet we've seen sort of a resurgence of sorts with respect to housing starts, with respect to housing sales volumes. And this morning, the MBA mortgage application number came in at a 3.7% gain. If you look at a month-over-month basis, after seeing several consecutive drops. How much are we actually seeing the rolling recession move away from industrials, move away from housing, move away from tech, and so kind of creating this real muddling inflation and muddling kind of economic growth?
Yeah, I mean, so, in terms of the housing sorts of numbers, I mean, it kind of makes sense. I mean, look what's happened to the 10-year Treasury security over the last, few weeks. That's brought mortgage rates down. And so, if you were sitting on the sidelines, that's a reason to maybe jump in right now. So, yeah, you have different sort of sectors that are kind of going in and going out. And I think that's typical for most shallow downturns. If you go back 20 years, the tech downturn, tech got hammered back during that period of time. But the housing market actually was booming 20 years ago. And so, this is not the financial crisis where everything was going down at one time, or the pandemic. This is a different sectors can kind of roll in and roll out. The big thing is going to be services spending. And again, I think, we'll see that start to contract later this year.
Jay Bryson, I've got to go back to your call tomorrow of a first quarter GDP of 0.8%. Construct that across C plus I plus G plus NX. Help me here with the partition of how you get to a sub 1% American economy.
Right. So, so again, we took down our PCE, the personal consumption expenditures, consumer spending. We initially had guessed that was going to be up around 4%. Now we're looking at 2.5%, given the revisions. If you look at business fixed investment, the I part of that, we think you're going to see a negative number in terms of the, in terms of at least equipment spending there. And then there's going to probably be a big drag from inventories. We had a big inventory build in the fourth quarter of last year, right? And so I think you're looking at a 1 to 1.5% drag there as well.
Peter Lynch's team years ago at Fidelity told me that domestic final sales was their religion in terms of looking at the American economy. If you've got a 0.8% statistic with export dynamics, where is domestic final sales?
John, I don't have it here off the top of my head, but I'm gonna guess we're probably somewhere 1 to maybe 1.5%. So
we don't have a recession domestic economy helped out by a good export number.
No, no. As a matter of fact, exports will probably be net exports will probably be a little bit of a drag in the first quarter number. Yeah.
I was completely rude there, Lisa. The reason I did that is because Jay doesn't understand this, but I need to make some news this morning. Qantas is in my ear. Will you ask him a question where we can make some news?
Well, this goes to the point that we were hearing from Peter Scheer as well, that there isn't necessarily going to be the same kind of global trajectory, a global kind of impulse as we've had in the past, starting with China and the fact that the China reopening is kind of a bust when it comes to how much they plan to import from places like the U.S. and possibly even Europe. I mean, Jay, how much are you factoring in kind of the changing global structure of trade as a reason for very slow growth and slower growth for the U.S. going forward?
So in the near term, I mean, it doesn't really have much of an effect. But we've did a series of reports on this in terms of deglobalization, if you will, and it's a modest headwind overall in global growth. Right. I mean, if things come back to the United States, which is good in kind of a long-term sort of sense, but as that transition occurs, the overall cost structure is going to go up. We're just not going to be as efficient as we were. It'd be one thing that would potentially weigh on the long-term potential growth rate of the U.S. economy.
Jay, be nice to Sarah House. Okay, come on. You're giving me a 0.8% statistic. Okay, I mean, Sarah's stressed out, so be careful.
Well, but she's our inflation guru. So this is more of a Tim Quinlan sort of thing in terms of the GDP sort of side of things.
Okay, Jay Bryson, thank you so much. Quinlan and House leading the charge at Wells Fargo with Dr. Bryson this morning. We've got to get back to the deterioration in First Republic. It's fractional. But nevertheless, other than two sharp spikes down, somewhat near the bottom for the day, down 15% intraday pre-market, if you will, on FRC 6.83 there as well. We've got some green on the screen. We lift back up to maybe where we were at 5:30, 6 o'clock this morning when Lisa came in. I wasn't here at that time. And the two-year yield 3.92% as well. Lisa, your observation on Gillian Tan's work, the reporting Bloomberg has on FRC.
Well, right now, First Republic is being viewed as a specific story, but with caution. And that really is the feeling that yesterday when we got that report, it brought the whole market down with it because people were thinking, oh no, we have to think about this again.
And then it separated out.
And then it started to separate out. PacWest came out with their earnings. It calmed people down. Those shares up more than 13% in pre-market trading. Still divergences, but there isn't a feeling of complacency here or calm. There is this sense that something is happening that is going to change the creation of credit in the months to come.
And Congressman Hill, a banker from Arkansas, I think was very eloquent about his faith in the institutions that were there in 1982-ish S&L crisis, overlaid on Dodd-Frank, and that those safety nets are there for the rest of the system.
Well,
to see on that.
The only problem is, and John mentioned this earlier, survive, not thrive. Are we talking about that kind of scenario where profitability is seriously challenged?
Story we'll cover through the morning with our banking team, Shonali Basak, on that story as well. Coming up, David Rubenstein at Carlyle Group. This is Bloomberg. Stay with us. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After months of North Korean missile tests, the U.S. will beef up the deterrence it provides South Korea against nuclear threats. In return, Seoul will pledge to honor its commitments to not build its own atomic arsenal. President Biden and South Korea's President Yoon Suk-yeol will announce the agreement today at the White House. House Speaker Kevin McCarthy has made changes to the debt limit bill to try to lure votes from Republican holdouts. Tax breaks for ethanol have been restored. That was a demand of Midwestern lawmakers. And now the measure will accelerate new work requirements for Medicaid. An independent team of aviation safety experts will review recent near collisions at U.S. airports. The 6 people on the panel will advise the FAA on how to improve the air traffic safety system. In January and February, there were 8 incidents involving airlines that were rated as severe by the FAA or resulted in investigations. Airbus and jet engine maker Safran warns that supply chain disruptions will continue into next year. That will complicate output just as airlines are demanding new jets. Airbus has flagged shortages on plane seats, semiconductors, raw materials, and labor. And U.S. Labor Board prosecutors accuse Starbucks of refusing to negotiate in good faith at 144 newly unionized cafes. That's according to a new filing. Starbucks hasn't responded. In the past, the company has said that it's the union that's not negotiating fairly. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
The Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rating World Cup.
This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
There's definitely a divergence in the action of stocks, and those big stocks that were sold off very heavily last year were reinvested in this year very heavily. So you've these big swings in these big stocks. There are so many different actions weighing on the different sectors that it's almost like you've had a slow rolling recession in different parts of the economy since last year.
Sarah Hunt, she's Chief Market Strategist at Alpine Saxon Woods. A personal note, if I could right now. Lisa Bramitz and Tom Keene, futures up 12. We're watching FRC as well. That seems to be clearly the story of the morning. I know they're watching it. Anne-Marie Horton making clear it is a topic of study in Washington as well. FRC in the 5 level, but back down again under 7, 6.92, down 15% today. We'll monitor that. If you go to where Lincoln died, at Ford's Theater in Washington, and you look across the street, next to where he actually died, in a quiet bedroom in the back of a house, next door, there is a spectacular museum of which substantial people in this country said, we have to build this with the memories, the iconic images, if you will, the iconic America, you will, that is all of Ford's Theater. David Rubenstein providing leadership on that project. across the street from Ford's Theater. He is with Carlyle Group and has a fabulous, fabulous study here of iconic America. And for the Keene family, start strong with Fenway Park. David, you've done so much for this country in terms of our heritage. Why did a Baltimore Orioles fan start with Fenway Park?
Well, of course, Fenway Park is the oldest ballpark in Major League Baseball, built in 1912. It was made famous early in the 20th century by a player named Babe Ruth, who actually came from Baltimore. He was born in Baltimore. And most famously, he was traded from the Red Sox to the Yankees.
I did not know that.
And the result was that, yes. And then for 86 years, the Red Sox did not win a World Series.
Oh, I did not know that.
That was called the Curse of the Bambino. But the Curse of the Bambino might not be because they actually traded Babe Ruth to the Yankees. It might have been because for many years, the owner of the Red Sox refused to have African-American players on the team. They gave a tryout to Jackie Robinson. He wasn't good enough. They gave another tryout to a guy named Willie Mays. He wasn't good enough. And so as a result, Ted Williams didn't have Willie Mays with him. Had he done so, they probably would have won World Series before. But what I tried to do in this series, there's 8 different iconic parts of America we talk about the plus and the minus of the things that people don't know as much about the history of these iconic symbols. And that's what I was trying to do, educate people a little bit more about our history.
David, it's a wonderful series spanning all the way to the Golden Gate. And I will say, David, I did in my youth sit off the dugout on first base side and gaze at Pumpsy Green standing next to Ted Williams out in the outfield. David, I want you to talk about the American cowboy. It's not something that we can see. It's not out, I-80 across Nebraska or down into Oklahoma. Right. Tell me about the American cowboy as iconic America.
Yes, when I was growing up and you were growing up, you probably watched TV Westerns on television all the time, and it turned out that that really wasn't accurate. We called those cowboys, but actually the real cowboys were people herding cattle to train so that they go to slaughter and to be used for meat and so forth. Those cowboys, really, they kind of people who succeed them now. There are not so many cowboys today, but there are people that do cowboy-related things in rodeos. And I went to a lot of rodeos in Cheyenne and Cody and Wyoming, and also in Fort Worth, to see what cowboys really do today. But the cowboys of old, they were not all white men. They were, large numbers of them were African Americans. A lot of them were Latino. We have an image that they were white men and they were shooting Indians at the time. That wasn't true. They were really herding cattle. And it was a tough life, but it was different than what we saw on television.
David, I can't keep track of all of the hats that you wear as you pervade into all spheres, which is fantastic. And what really strikes me in this article about this new series that you're doing, you were quoted as saying, "I don't support any candidate anytime, anywhere. I don't give any money to politicians, no matter who they are. I've never given a penny to anybody running for president of the United States. Instead, it's to historical institutions to try to educate people on the past." Why?
Well, I am the chairman of the Kennedy Center, and I'm chairman of the National Gallery of Art and the Library of Congress Board, and I think it's more effective to do those jobs if you're not involved in politics, so I can talk to Democrats and Republicans. Mm-hmm. Secondly, I think that the way politics works today, if I'm giving large sums of money to people, which is fairly common for business people to do, you're seen as having bought something and maybe done something you shouldn't do. So rather than participate in that, I just stay out of it. I'm registered as an independent. I did work in the White House for President Carter. I'm glad I did that, but now I stay out of politics.
David, I need to talk about the present business at hand, and somebody's looking for a rescue of wealth management schemes wrapped around the shroud of banking. Can big money like Carlyle, Apollo, and others, can they come to the rescue of fractured banks like First Republic?
I think the FDIC would prefer to have banks as opposed to private equity investors buy these assets, in part because banks, actually are in the business of running banks, and they can consolidate them more readily. I think there is a concern about private equity people making a quick buck or something like that, which was seen as happening the time we had the last great problem in the financial service area. With respect to First Republic, it has some real challenges, but the principal issue for a bank today is that there's a hole on the balance sheet. And with the hole on the balance sheet, somebody has to make that hole. It's either the banking organization that buys it has to say, okay, we're willing to take a loss because we'll make more profits down the road, or the federal government has to say, we'll make you whole, which was done before in 07, 08. I think right now there's a lot of political pressure not to bail out shareholders or bail out creditors and, in effect, not make it possible for banks to come in and get that hole paid for by the federal government. That's the principal reason you haven't seen somebody yet buy First Republic.
Is your sense that these stories that we keep hearing about in the regional banking sector, that it's idiosyncratic, or is your sense that it is a broader issue having to do with the interest rate regime we're in?
Well, interest rates going up have not been helpful because people, what a lot of the regional banks did is they bought federal securities, federal treasury securities, and those are worth less if you mark to market those. Now, they're not having to mark to market, but if you do have to crystallize a sale, as was the case with Silicon Valley Bank, they had to crystallize a sale. The things that they had to sell were sold at less than people thought they were worth because interest rates have forced the value down of some of the credit, some of the securities these people held. So that's the problem. But right now on First Republic, I think government would like something to get done. But I think some point somebody has to blink and say, yes, we'll make you whole for losses that you might absorb if you buy that bank. And right now there's a lot of political pressure on Capitol Hill not to do that. But I suspect in the end, something will have to get done. Otherwise, that bank will not probably be able to find a buyer.
David Rubenstein, thank you so much with Carlyle Group. And of course, putting together a series of programs, 6, 7, 8 programs out to the Golden Gate Bridge, Iconic America, tonight, 10 p.m. on PBS, 10 p.m. on PBS tonight.
What he just said there was really interesting, that basically until the government guarantees to help make people whole for losses on the balance sheet of First Republic, a deal isn't going to get done. So somebody has to blink, and Washington doesn't want to deal with the political fallout from being considered part of a bailout of what could be considered a bad actor or a fraud.
It's a really important comment, and the good news is we've only got 1 minute to talk about it, maybe a minute and a half, so I'm not going to get myself in trouble here. This goes back to a generational issue, and Ruchir Sharma and the FT 10 days ago, Rockefeller Foundation mentioned this. There's this whole new thing, the rescue culture, which Mr. Rubenstein alluded to. You know what? There's a hole in the balance sheet. Nothing else matters. You got to plug the hole. And we've got this touchy-feely modern process now where everybody's going to feel good and nobody, it's like a blue ribbon at Little League Baseball. Nobody's getting a blue ribbon for showing up in the FRC debate. Somebody's got to fix this.
Well, and then this is really the key question. Is it the government? Is there an interest by government officials
always the government.
to step
this
in?
Is Alan
why? Right? Where is the discussion about why not let it fail? If there is distinction in the economy about good banks and bad banks, then what's the issue if it isn't systemic?
Under central banking theory, I'm going to quote Alan Meltzer 101, we have a lender of last resort, knowing that the banking industry always at some point has failures. You have to have a failure process. That's what this is about.
Who are we protecting? If it isn't depositors, right? If depositors are protected,
we can't protect the fat cats. We can't. What David alluded to there, and I agree with you, it was newsmaking. What Mr. Rubenstein said is there's this whole mood that the fancy people around this bank can't be compensated for it. So it just falls away here. Right now, it's falling away. You do this to me every morning, Lisa. Like you ruin my 9 o'clock hour. 6.98 on First Republic. We'll be following that. Stay with us.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Live from New York City this morning. Good morning, good morning. This equity market trying to bounce, encouraged by some decent tech earnings from Microsoft. Futures right now, positive, 1/3%. A countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Microsoft kicking off tech earnings with a bang. First Republic considering major asset sales, and McCarthy pushing for a vote on his debt limit plan. We begin with the big issue. Big tech delivers big beats.
Microsoft and Alphabet,
they've essentially delivered
very strong, dominant market positions.
That, I think, rally for mega cap tech can probably go a little bit further.
I think there was a lot of fear kind of going into earnings. Overall, we're starting to see some stabilization. Clearly, they were able to meet those expectations.
We know that tech companies have done a lot of cutting since the end of last year, early this year.
You've seen them cutting headcount dramatically.
They already ripped the Band-Aid off on guidance.
Got strong balance sheet companies, highly cash generative, with relatively stable growth.
We've seen the market more recently prepared to pay up for characteristics associated generally with growth stocks and with tech.
It's still early in the early earnings season.
We've got a lot of tech companies. This is going to be a huge week for stocks.
It's a huge week already. Joining us now is Brent Thill of Jefferies. A busy afternoon for Brent. Brent, wonderful to catch up with you, sir, as always. Just going through the names under your coverage. Google a buy, Microsoft a buy, Meta a buy, Amazon a buy. Did you like what you heard yesterday?
We liked what we heard. We think ultimately the fear going in was way stronger than what happened. The positive results from both Google and Microsoft. I think Microsoft is the standout. Where you're going into your seasonally strong fourth quarter. AI is starting to have an impact on the Azure business. It still hasn't hit the application business. We raised our price target to $350, and we ultimately believe there's a tidal wave of AI activity that's about to hit, and there are very few ways that you can play this trend. Microsoft was executing well ahead of AI, and now they're ahead leading the charge in AI. They didn't lead the charge in cloud. They kind of caught the wave late. They're now way in front of this, and I think investors need to be in front of this as well and continue to be long the stock. Google, we think, was fine. but I still think there's concern around their spending. Are they behind in AI? And again, some of the lack of the disclosures and the lack of color around the business still has investors still questioning a bit. So a good print, but I think that ultimately the confidence is so much stronger with Microsoft's quality management team, the quality of the guidance, and the quality of disclosures that, you know, at this point, it's really hard to bet against the Microsoft story here.
Let's just sit on that name and explore that story further. Nadella saying all the right things yesterday, a generational shift in search because of AI. Brent, I'm going to ask you a question that you've posed, your own question, if you will. Do those numbers yesterday even matter, given what this stock is trading on right now?
They don't. And we said going in that it doesn't really matter because the shift is in what they're going to do with OpenAI going forward. And all the pricing and all the economics still have yet to hit. And so ultimately, yesterday, the results were better than feared, and that helps the story that everyone was excited. You know, no hedge fund wanted to short this, no long only wanted to sell this. They wanted to load up more and continue to be long this into this cycle. So we look at this. They have not unveiled any of the economics yet for their application
Connection
business.
lost.
They still have yet to see all these software companies that are embedding OpenAI in the fabric of their products, the economics from those businesses. This is all to come. And so, you know, it's rare you can see, you know, the ultimate kind of next couple of years that unveil for this, which is they just get stronger and they get not only in their infrastructure business with Azure, but in their application business. So they have products called Copilot that let productivity workers do their job easier, faster. Developers write code faster with Copilot. And some of the Copilot pricing, you know, doubles the pricing of the product and in terms of seat count. So, you know, if you were spending $20 a seat, you could spend 40 with it AI infused. So when you look at some of what's about to hit, it's rare where you can actually see this far ahead. And we don't believe this is hype. We believe this is real. Yes, we got to pour a little cold water on AI that not everyone's going to use it. And ultimately, there's going to be a select number of users. But this is no doubt Microsoft's ahead of this. They weren't ahead in cloud. Nadella came in. He had to turn things somewhat around because they had not gotten off on the right foot.
Yeah.
And I think really he understands that they can't be in the wrong side of this. They're way out in front.
I wonder if that principle applies to Google on this front as well. As you say, Brent, Microsoft was late to cloud but still succeeded. Do you think we're writing off Google a little bit too quickly, too much?
I do. I think Google's going to be fine. I think they've talked about this. I think everyone thinks that conversational AI is the only AI that's out there, and ultimately, I think these chatbots are going to be helpful, but that's not going to be the only thing. Google's been working on AI for a long time. I mean, Waze has been driving your car around traffic for many years. Google's had Google Assistant on my iPhone for many years that gives me weather or updates on flights. So they've had AI. I think they got flat-footed a little bit, and they've been doing more PR in the last 2 months than they've done the last 2 years, probably, to kind of iron things out. But I think that people have definitely written them off. I don't think they're as bad a shape. Look, the vendors that have the content and the users will win in AI, and that's Amazon, Alphabet, and Microsoft.
Let's finish on Amazon. We can talk about Meta, but it's almost too easy. The stock's absolutely flying. I think the only question that remains there is whether that's a reason enough not to buy it, because we've had a massive year-to-date gain. I want to talk about the stealth rally that we've seen in Amazon that no one's talking about. Brent, everyone talks about Meta and the year-to-date gain. I've hardly heard anyone talk about the year-to-date gain in Amazon of something like 20%. Brent, what's behind that?
I think what's behind it is what's fueling the rest of big tech, right? When the bank failures hit in March, I think everyone rotated out of banks in a sector rotation on energy back into tech. They went to these big, safe balance sheet stories. And I think around Amazon, it hinges around two things. Number one is AWS. If Google Cloud and Microsoft Azure are doing as well as they are, I highly doubt that AWS is going to blow up on Thursday, right? So AWS is the cash cow. So we know that is a great source of profitability, and they probably aren't falling off a cliff. Everyone is expecting them to fall off a cliff. The expectations on the buy side are so horrible that we just now have an expectations re-rate because everyone got too bearish. And then number two is on the logistics side. They have the chainsaw out on expenses. They're cutting expenses, and this is what we need to restore the health of the logistics in retail business back to normal. And they're making these cuts. So I think the combination of AWS combined with the cuts on the logistics side are feeling more excitement.
Yeah.
To your point, it's been super stealthy. No one wants to talk about it. Everyone wants to talk about Microsoft, Google, and NVIDIA and others. No one wants to talk about it, and it quietly outperformed Microsoft and Google year to date. So, a little bit tougher setup now going into Thursday, given what Google and Microsoft did. Ultimately, we think their expense discipline will continue. I think the only caveat on Amazon is if they get into food in a bigger way, that Jassy has been indicating, that's kind of the party breakup. The cops are showing up to the party on that one, which is you finally are going to restore AWS. You get the supply chain under control, and then you go into a very low margin business like food in a bigger way. They're already there. Everyone's a little nervous on that, so we're all keeping an eye on what's happening there around grocery and food.
Hey, Brent, thanks for the input this morning. Brent Thill there of Jefferies, looking back at Microsoft, Google, looking forward to Amazon tomorrow, Meta after the close a little bit later. Here's the other side of the trade. Nadia Lovell of UBS joins us right now. Nadia, you say sell into tech strength. Why?
Yeah, tech has been weak over the last week. We're seeing some strength this morning, just given how strong the numbers were. But we're more looking at it from a valuation standpoint. Valuation are quite extended in this space. This is a space that's now trading at 35% premium to the broader market. And the top two names within the space are trading at a 45% premium. So we just think that is priced for near perfection. And so we would take some chips off the table here and start to cycle into some of the more defensive sectors, or digital surveillance sector, and also outside of the U.S. I think that Microsoft is in a unique position, and we cannot extrapolate this to the broader tech sector. Of course, Microsoft has benefited from cloud and also now, excitement around generative AI. But we are seeing signs from some of the other companies in software over the last couple of weeks pointing to a slowdown in spending in IT, and also just an extension of the selling cycle and more scrutiny around some of the larger deals. And so we'll be listening more closely for the rest of the earnings season. I think the bar has been raised for a lot of these companies, just given how strong Microsoft earnings were last night, and we might not get the same follow through.
Three sectors you don't like. Tech's one, discretionaries another, financials the third. Nadia, we've got a lot of news around First Republic, one financial institution. That stock got hammered yesterday, basically cut in half. From what you see, is that one bank, one problem, or have we got a broader problem here?
Our cautious on financials, which we've been since last year, has to do with deposit costs. And we think that those are going to continue to increase. Yes, you are seeing some stabilization in the deposit outflows, but doesn't mean that it's going to stop. We still think that these deposits are going to seek higher yields elsewhere, including outside of the banking system. And if they do stay in the banking systems, the banks are going to have to pay up for this. And this has implications for margins. Also, we know that credit lending standards are going to continue to tighten, and that has implications for loan growth. And so we just think that it still remains a challenging environment for the banks, and regulatory conditions are going to tighten further. We're already seeing some banks pause their buybacks, and we're also seeing indications from some of them for slow buybacks going forward. So even the capital return story is facing some headwinds.
3,800 price target on the S&P. Nadia Lovell of UBS. Nadia, thank you, as always. Bob Michael of JP Morgan Asset Management, the CIO, joining us around the table. Bob, good morning.
Good morning. Happy
Do we have a First Republic problem or a banking problem?
Well, I think we have both, and I think it's somewhat naive to say that this is just limited to First Republic. If you step back and think about it, this should never have happened. This went after the most heavily regulated, capitalized industry on the planet, banking. And the regional banking system, I think, is quite vital to the U.S. So I think it is a crisis. I think the regional banks are heavily dependent on the FDIC. They're heavily dependent on the Federal Home Loan Bank to get additional cash. We don't know how they're going to operate when those two programs expire.
Is it a crisis that is ring-fenced, so to speak, or is it a crisis that bleeds out to the broader economy and leads to a credit crunch?
It's ring-fenced as long as there's continuous progress to some sort of resolution. And I actually don't think the savings and loan industry back in the late 80s, early 90s is the wrong thing to look at. Some sort of consolidation, some sort of agencies, a technical assistance committee at the FDIC or the Fed to help these regional banks when they see a surge in depositor inflows or outflows, or when they see an asset liability problem. Those are the kinds of things that you need. But I think what we've actually seen is that the deposit outflows just didn't occur because they occurred. They occurred because businesses and households are burning cash in a big way. And it's the higher price of everything, and it's the higher cost to finance everything. So if you're in the couple lower quintiles of earners in the U.S., we're already seeing in the Chase data that you're depleting your deposit balances because of the higher cost of groceries just to live. And businesses, as they're rolling over their floating rate funding, it's double or triple what they put it on.
Okay, this is the third point that hasn't been discussed enough. Point one is worries about return of capital. You take it out of a beleaguered financial institution, park it somewhere else. Point two is about return on capital. You take it out of a bank, give it to a money market fund. You're on to point three. You're saying that there's that much pain out there right now that we're just burning through money in the United States.
Of course we are. When you look at, you could look at our own Chase data, you could look at the Federal Reserve Board data, you see that the bottom quintile of earners have been most punished by the high price of everything. So that excess savings that they accumulated during the CARES Act, they've blown right through it. Their deposit balances are below where they went into COVID. Now, they're not frittering it away on stuff. They're spending it to live off of. We're looking at revolving credit at now the highest rate of usage in a long time. And by the way, putting more stuff on your credit card is not being used to consume more, it's going to service your debt. And we already know when you talk to businesses, the pressures they're feeling about the cash burn on the new rate of floating rate debt.
Hold that thought, because the next logical question is the Fed done? Bob Michael's going to reply to that in about 5 minutes' time. Bob Michael's going to be sticking with us. First Republic right now is down about 12% in the pre-market. Coming up, First Republic mulling a $100 billion asset sale.
They have a lot of government securities and loans that are simply underwater because of interest rate. It's important that it's not a credit issue. It's more interest rates. There's three ways out of this. They can raise capital, they can sell, or they can fail.
That conversation up next.
Bloomberg's The Open is brought to you.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
From New York
City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
In the case of First Republic, it's impossible to wait. They need a solution, and they need one very quickly. The lack of knowledge and, of course, the lack of questions Monday night didn't help matters. And so here we are. There's three ways out of this. They can raise capital, they can sell, or they can fail.
From triple digits to double digits to just south of $7 in the pre-market, First Republic plunging to a record low after a very rough Q1. That stock still falling in the pre-market, the latest coming from Bloomberg reporting they could sell up to $100 billion of assets in an attempt to shore up the balance sheet. Elsewhere, PacWest, those earnings painting a very different picture. Deposits stabilizing, with leadership saying this: they rebounded nicely in April, increasing approximately $700 million. Shonali Basak has more. Hey, Shonali.
Hey, John, it's certainly a tale of two cities here. We were looking at two banks that the market was very worried about. PacWest down more than 55% up till yesterday, now jumping more than 14% pre-market, as it shows that not only have deposits stabilized, they're also coming back at the beginning of April. Now, over at First Republic, you have a stock that was down more than 90%. As you say, it's still dropping pre-market, and the problem here is the story moving forward. Now, the big overarching question is, what is the regional banking model? How do these companies make money moving forward? Their credit ratings are certainly under pressure. And here's the real difference between First Republic and PacWest. PacWest was already a firm that announced a partnership with the private capital provider here before a credit line. We know that private capital is standing on the sidelines looking to get into the banking system, but it's not true for everybody. The more that we see trouble ahead, the more the story is difficult to unfold. Certainly that's the case for First Republic. That $100 billion asset sale figure is just one option of many. The question is, if it remains a standalone bank moving forward, what is the business model? Of course, we've seen a series of downgrades for that bank already through yesterday, but until the story going forward is clear, what is First Republic tomorrow, that it's hard to get people back into the stock.
The only clear thing right now is this is painful. Shonali, thank you. That stock is down by 12.6%. As Gianni Montgomery Scott put it, the analyst over there, three options on the table here: raise capital, that's difficult, sell assets, or fail. That's what's on the table for that institution right now. The name is down by a little more than 12% in the pre-market. Back with us, Bob Michael at JP Morgan Asset Management. Bob, I left the question on the table about 5 minutes ago. Let's answer it. Is the Fed done?
No, the Fed's not done, because the Fed looks at coincident and lagging indicators. So the things it's going to gravitate to are the low level of unemployment in the U.S. They're going to look at some of the tech earnings of the last couple days and say, it still looks pretty good. We need to continue the pressure. So I think they'll do one more. I think it's entirely unnecessary. I think the last rate hike was entirely unnecessary. I think the cumulative and lagged effects of monetary tightening are here. Everything we look at, which is a leading indicator, has rolled over in a massive way.
Leading indicators rolling over. When does the Fed get to look at those leading indicators as lagging indicators? When do they start to realize that? Is it the summer, after the summer, September?
I don't know. They must have models, right? Because we look at things like continuing claims. And if you look at the change in 6-month, 9-month, or 12-month continuing claims, they've risen at a rate you've only ever seen in recessions. When we look at the senior loan officer surveys, and you see that 48% of respondents are tightening net credit conditions, it's only been that high in a recession. Then you look at the Conference Board data. You look at Conference Board leading indicators. You look at current versus future indicators. All of those things are in recessionary levels. There are a handful of things that are saying we're in recession right now. If we're looking at them, the Fed should look at them and put some credence behind them.
So you've got a call, I believe, for a rate cut in September. Is that right?
Yes, we do.
What's inflation look like when they're cutting rates?
Well, that's the other thing that's happening. Inflation is rolling over in a massive way. And again, there's a whole range of data. We think by the time they cut rates, it will be below 3%. on both the 3 and a 6 month annualized run rate. If we look at things like core CPI, ex-shelter, the trailing 6 month annualized is 1.8%. That's down from a peak of 7.6%. You look at Case-Shiller housing data. From a year ago, home prices are only up 0.4%. You look at the National Federation of Independent Businesses, plans for price changes over the next 3 months are the lowest level, only at those levels in recession. I could keep going on and on and on, but there, look at oil rolled over again, despite the production cuts. So all of these things are happening right in front of us. We look at supplier delivery dates. They're now the lowest, it's the lowest time to receive your supplies since 2009. Recession. The data is right there in front of us.
You want more time to talk about it? I'm going to give it to you. We can continue this conversation in a couple of moments. Just the very idea that Chairman Powell has spent the last year or so doing his best impression of Volcker, and he's going to start cutting rates with CPI near 3% a few months away. We're going to have that conversation a little bit more. Coming up, the morning calls in later. Here's the bond market call from Bob. The whole curve, the 2-year, out to the 30-year at 3%. 3.00% is the call. That conversation around the opening bow. Plus, breaking down the bond market with BlackRock's Rick Reeder later this hour.
Electric Dream Days are here.
Edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Equity's just about positive. Let's get you some morning calls. Jefferies downgrading Tesla to hold, expecting lower returns until earnings upgrades start emerging. Morgan Stanley raising its Alphabet price target to 140, highlighting the company's quarterly results. And finally, BMO upgrading Microsoft to outperform better than expected results, leading at least 16 different analysts to raise their price targets following Q3 results. Up next, markets getting a boost from big tech earnings, Meta and Amazon on deck.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Seconds away from the opening bell this morning. Good morning to you all. Going into that opening bell, equity futures positive by close to 0.2% on the S&P 500. On the Nasdaq, a little bit more off the back of a rally in Microsoft, up anywhere between 7 to 8% for a big chunk of this morning so far. First Republic, a name to watch that we'll get to in just a moment. That's down going into the open by about 12%. That's the opening bell in New York City. Let's get it open for you. First couple of seconds of trading on the S&P 500. We are positive by 0.500. Taking a while for me to get you a price on the Nasdaq. When that comes through, I'll get you one on the Nasdaq 100. Expecting a boost there from the numbers from Microsoft, and then a little bit later, Meta, the high-flying name in technology, second biggest winner on the S&P 500 so far year to date. Here's your move on the Nasdaq at the open, higher by about 1%. Outside of that, into the bond market, let's look at the bond market right now together. Treasury yields, your 2-year, a break of 4% in yesterday's session, led lower by some of these regional Fed indicators that we get time to time. They've been coming through over the last couple of days, indicating a little bit of economic weakness. The 2-year's dropped to about 388 on my screen right now. The 10-year yield back down to sub 340 at 339. If you want the constructive view of things right now, one stock to look at, Microsoft, snapping a 4-day losing streak after topping profit and sales estimates. Abby has more. Morning, Abby.
Hey, John. Well, this stock is really flying on the morning. It is up more than 7%. Its best day of the year and a great quarter right across the board. And sort of surprising because yesterday the stock traded very heavy, as you were mentioning, down for a number of days in a row, trading as though investors thought that it was going to miss in some way, but it was very clean. They beat top line, bottom line estimates. Very importantly, the cloud services unit grew by 27%. But of course, as you know, the big thing is AI. They're talking about the idea that search is going to have a new future, all about AI, and because of their ChatGPT acquisition, they're integrating that into Bing already and seeing positive results. Now, not so much for Activision. The UK has, of course, blocked that $69 billion deal of Activision by Microsoft, saying that that kind of deal would create a lack of competition in the cloud market, even though it's a gaming deal. Activision down sharply right now, down 9%. But again, Microsoft up 8%, best day of the year.
Flying. Abby, thanks for that. Big tech competition, heating up. Alphabet delivering a beat in sales and revenue. Their cloud unit turning a profit for the first time. This coming as the search giant faces a major challenge from Microsoft's AI-powered search engine, Bing. Ed Ludlow on the West Coast has more. Hey, Ed.
Yeah, good morning, Jonathan. A much more muted reaction to the Alphabet story. We're just a few tenths of a percent higher, basically flat. A beat on the top line, $58.07 billion of revenue excluding traffic acquisition costs. Performance on the bottom line, it kind of dispelled fears that the generative AI-driven battle around search was impacting the fundamentals of its search business. Probably the biggest bright spot is cloud, $191 million of operating income. That is profit on that cloud business, and I believe we have a terminal chart that demonstrates that for the first time. What that was driven by, according to Ruth Porat, Jonathan, the CFO who I spoke to on the phone, was some upside in terms of revenue and volumes, but cost discipline as well. And remember, the big story for Alphabet, the parent of Google, was demonstrating the impact of cost cuts. There was a $2.6 billion one-time charge booked in the first quarter relating to severance and real estate. And then you talk about the macro picture. They did concede that actually, macro speaking, there is a worsening outlook that makes things uncertain. YouTube continued to slow down its growth and decline in growth, but the word that executives use, including Ruth Porat on the phone with me, was stabilization. Long story short, investors aren't as thrilled about the AI story with Alphabet as they are with Microsoft. The battle continues.
You see that in the stock price this morning. Ed, thanks for that. Looking forward to the coverage with Caroline Hyde a little bit later on Bloomberg Technology, on Bloomberg TV at about 12 Eastern Time. Look out for that. Here's a call from the South Side. JMP Securities maintaining their market perform rating on Alphabet, seeing a number of headwinds still in place, saying this. The analyst writes the following. This report is the first sign of stabilization for search and YouTube, but advertising demand continues to face macro headwinds, and there's the potential for search to face significant change. Alphabet struggling this morning relative to the enthusiasm around Microsoft. Shares of PacWest elsewhere, and First Republic moving in opposite directions. PacWest deposits showing signs of recovery as First Republic considers an asset sale of up to $100 billion. Janali, two different stories for us this morning.
Two different stories. You're seeing it in the trading. You have PacWest up about 10% as the market opens here. You have First Republic extending declines. Started the open at about 17% lower after a nearly 50% decline yesterday. Now, it's interesting because we have seen throughout the course of this cycle, certain banks trade in synchrony. We are starting to see the pack start to separate the winners from the losers here, and a lot of it is in context of what is available to them in terms of capital markets. Until, as we've been talking about, PacWest figures out what it does, whether it is selling the bank, selling parts of the bank with assets behind it, or parts of the assets rather, or going into receivership, which, as we know, it's made pretty clear here that is the option that the government and the bank is trying to avoid. It is hard here to grasp on to the story. A lot of noise out there, John, but, you know, keep focused on the road ahead.
Yeah, we'll try and cut through that noise throughout the whole of this morning and into the afternoon. A big day coming up for First Republic, that's for sure. Bob Michael at JP Morgan Asset Management patiently waiting alongside me. Bob, let's go through this bond market together. 2-year, 389, 10-year, 340, 30-year, 365. Your call. 2-year, 3%, 3.00%, 10-year, 3%, 30-year, 3%. What is it that you see, and we could build on the conversation from earlier around disinflation, that's going to pull this curve all the way back in, 2-year out to 30s?
You know, having listened to myself earlier, I think I may be a little too high in terms of that prediction. I now worry we could be lower in yield. I think, honestly, what we're not appreciating is that we're seeing the most aggressive and pernicious pace of tightening by central banks, I think, in history. So if you look at the pace of rate hikes, you have to go back both in the US and globally to 1980 to have seen anything like this. So a rate shock is being delivered to the system in a big, big, big way. The regional banks, I think that was a large part of the problem. There will be more. We heard Ed talk briefly about Alphabet, and I think I heard property write-downs in there somewhere. There's the entire commercial real estate market we haven't even talked about. So I think the rate shock is big. I think the second thing nobody's really talking about is quantitative tightening. That's sucking the liquidity out of the system. It's draining reserves. And if you are like me and you believe in the money multiplier effect, This is effectively the money multiplier effect in reverse. On top of a banking crisis, credit conditions are tightening at an alarming rate. The Fed ultimately will see this. They ultimately will have to cut rates. They see the damage. Historically, they've seen the damage that aggressive rate hikes have created. They do want to slow down growth and inflation expectations. Recession materialized in the horizon. Halfway there, they've always cut rates.
Let's start the conversation at the front end of the curve, and then we'll go further down through it. The very front end, super sensitive to what the Fed's going to do. So the logical question for me to ask you is, what's the Fed going to cut rates down to? How do you get a read on that?
I don't know. And I don't know if going down to 3.5% from 5% is enough. Do you have to go down to 2.5%? I think the market's going to be ballparking things and saying, well, they'll probably have to take away roughly half of the rate hikes, so something like 2.5%. I think where the market will head and what we're seeing in the long end, ultimately the curve will flatten around something. I think 3% will be the opening gambit for that.
Why does that lead to a flat curve and not just a really steep one? When I look at some of the numbers that we've got from companies this week, help me go through this. Kimberly-Clark, Procter & Gamble, Coca-Cola, PepsiCo, there's 4 big companies in America. Double-digit increases to prices, no pushback from consumers. It's hard to make the argument based on that, and I know that's a very small slice of the indications, the data that we can get, the indicators, etc. But when you go through those numbers, it's very difficult to make the argument the Fed backing away is backing away anytime soon, and the 10 years going back down to
Not in the least. I look at that, I listen to some of the tech earnings, and it makes perfect sense to me. The last thing you want to give up is your brand loyalty. You'll start cutting in other places, but right now, if you like Coke Zero, you're just going to pay whatever it is for Coke Zero. At some point in time, you will see that come under pressure as unemployment goes up. Tech, I think businesses have learned in the last 20 years. If you go back to the 80s and 90s, one of the first things to be cut in a slowdown was your tech budget. We've all learned since then that actually tech is the holy grail for efficiency. That should be one of the last things you've cut. We've just run through a week where the last things businesses and households want to cut are reporting. Let's see what happens after that. I do think that we're going to see a pretty significant recession. I think it's somewhat naive to say that we've seen this massive fiscal and monetary stimulus, which we needed to get through COVID, and now we're going to withdraw it. And we said 18 months ago, boy, when it comes out, it's going to be a painful adjustment. And now we're saying, oh, no, it'll be fine. It'll be soft landing.
Short and shallow.
Yeah, ridiculous.
That doesn't resonate with you?
No, I think it's going to be a fairly moderate recession.
Okay. So when you look at the yields right now, the 10-year, you say your target might be too high, 3.00%. You really want to put someone on the spot, you ask for a price and a time horizon. So you've got to give me the time horizon. How long is it going to take for this to play out?
So I think I've been pretty good about giving a time horizon.
You think the next 3-4 months?
Yes, historically, from the last Fed rate hike to recession, it's averaged 13 months. We're saying that the last rate hike will be in May. By November, December, you'll be in recession. So we've compressed that because of quantitative tightening and the rate of increases in central bank rates. And we've also said midway to recession, the Fed starts cutting rates. That's how we get to something like September. I've been out meeting with clients in the Midwest, the West Coast, overseas. I'm hearing the same thing. We're underallocated to fixed income. Boy, we wish we bought in the fourth quarter. We're going to wait for a backup and come into the market. I think that's one of the things that starts driving rates lower.
Okay, in treasuries, just finally on credit. You hands off right now, backing away? If you're thinking recession's coming, you're not touching high yield, are you?
I'm not, and believe me, our beloved high yield team in Indianapolis pleads with me about it's a better quality universe, and on and on and on. All true. Default rates may not go to where they once did in the past, but even in the worst of times when default rates went to 10%, the other 90% of the market priced to 70 to 80 cents on the dollar. We've not seen that yet. We look at the leveraged loan market, only 12% of it is priced 80 cents or lower. When the entirety gets into that 70 to 80 cents range, then we'll know that we're in recession.
This is pretty bearish stuff, Bob Michael. A clinic, as always. Thank you, sir, of JP Morgan Asset Management, the CIO. Coming up very shortly, Rick Reeder at BlackRock on this. Speaker McCarthy giving into pressure and changing his debt limit bill.
This week, we will pass a bill on this floor that will lift the debt ceiling.
The update from Washington, up next.
Difference between political gossip and policy intelligence. Bloomberg Government provides our clients.
The moment news breaks, no one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
This week, we will pass a bill on this floor that will lift the debt ceiling, something the Senate has not done, something the President has not negotiated, and send it over to the Senate. Because we think this is a responsibility.
Speaker McCarthy making last-minute changes to his debt limit bill, hoping to garner more support by amending work requirements and ethanol tax breaks ahead of a vote this week. This as President Biden pushes back on the proposal, the White House writing in a statement that he would veto the bill if it's brought to his desk. Anne-Marie has more. Morning, Anne-Marie.
Good morning, John. What you're seeing from Speaker McCarthy is really he's caving to his conference. This happened overnight, just hours after he made that statement to reporters saying he would not entertain any changes to his debt ceiling bill, but he did just that. In this one amendment, what you see is some restoring of these tax breaks for biofuels and investment in biofuels. This really irked Midwestern Republicans. We also see an acceleration of the work requirements in Medicaid from 2024 to 2025. But it remains to be seen, even with these amendments, if McCarthy was able to shore up the votes he needs to get it to 218, and Jonathan, still to be determined whether or not he puts that bill on the floor today for a vote.
I cannot believe we continue to play this game. Anne-Marie Hordern down in Washington,
Just the
D.C.
start.
I know, but you can tell I'm already getting frustrated about it. AMH in Washington. I think a lot of us are going to get frustrated about this. Joining us now, Rick Reeder of BlackRock. Rick, fantastic to catch up with you, sir, especially when you're on the road meeting clients. We appreciate it, sir. Let's start with this. This debate around the debt ceiling. Rick, is it any different this time around?
So can you put me in the camp of frustrated as well? Because we are going to go through it again. Is it any different? I would say you have a more strident set of polarized opinions on both sides of Congress, which makes it and the administration to make it incredibly difficult. My sense is they're going to come to a resolution. My sense is they're going to take us through the mud before we get to that place, but it's going to be frustrating along the way. You think about the other duress in economy slowing, financial credit contraction. It's just not something the market needs at this point, but my guess is we're going to get some of it.
So let's make a call on the Treasury market. You heard Bob Michael at JP Morgan Asset Management a little bit earlier this morning in this hour, looking across the curve. Rick, 2-year out to 30-year, seeing 3% and maybe even lower, Rick. When you hear things like that, Rick, what are you thinking?
So, I mean, listen, I think the direction of travel is the economy slowing, credit contraction, financial transmission is changing. When you shock interest rates this high, you do create a dulling of economic activity, and I think that's right. So I think rates are coming down, and however, I mean, you have to put in a perspective where we were last week and this week. I mean, last week, it was pretty incredible when the deposit situation appeared to stabilize the banking situation. There was a lot of selling of interest rates. I mean, we moved 33 basis points in the front in the last few days. So listen, I think there's a lot of smart people who I have some sympathy for who believe in this idea that inflation is going to be sticky. You look at the UK, you look at Europe, and you look at wages, they are coming down. You see some improvement. Part of why I think the rate is that rates are coming down is because I think that inflation's coming down. But there's a real argument around deglobalization, infrastructure spend, keeping inflation elevated. So, listen, I think you've got to be in markets like this that have no conviction. I think when rates move higher, you got to buy them. But I don't think you have to chase them when rates move down like they have in the last couple of days.
Just to keep our audience up to date on some of the moves elsewhere, First Republic in early trading down by 18%, about 20 minutes into the session. Rick, these financial struggles, I think there was a hope that things had stabilized. We could leave these issues in the background, make them history. March's problems, not April's, May's. Looking forward from here, this is the question I asked Bob. Rick, I'd love to get your view on it as well. Is that a First Republic problem, a banking problem, a Fed problem, something much broader than that?
So, Jonathan, I'm actually blown away by the incredible focus on deposits. Because at the end of the day, I mean, listen, I think the Fed and Treasury have done a good job of generally stabilizing the deposit dynamic, save at a couple of stressed places. That being said, the bigger issue is the deposits. The cost of those deposits is well above what you're returning on your assets. So you've got a banking system that's upside down in terms of where you can accrue top line revenue, where your assets. You've got assets yielding 3.5%, and you've got your liabilities now at 5.5%. That's the issue. And by the way, the banking system is only about 15 to 20% of the liabilities, the funding in the country. So you have a dynamic today where the funding, the costs, where the Fed has kept rates too low for long, and then they shock them higher. It will create more rumbling pressures in financial transmission. And I think it's pretty clear that you're going to take, 0.5% or so off for GDP because of tangible credit contraction, not just in the banking system, but otherwise because of that, where rates were. And now that you've shocked them higher, the rollover financing that has to happen in real estate, leverage loans, et cetera, you're going to have to start rolling over this financing at significantly elevated prices, and that's going to have an impact.
So, Rick, just to keep it super simple, you've got this asset-liability mismatch at some of these big financial institutions. They're going to have to rebalance that and sell down assets. One example of that might be, say, a bank goes out there, offers a mortgage with rates at record lows. That mortgage might have, say, 3%. Now they're paying up 4% for deposits. They're going to have to do something about that. Now, Rick, with that in mind, you're in the market to buy, aren't you? Aren't there big opportunities for you as this develops?
So, Jonathan, I mean, yes, as a matter of fact, I mean, there are, you've got to be thoughtful about supply and demand. Where is the supply coming, and try and be patient around some of these areas. But definitely agency mortgages, which have been coming out in size. We've owned some of those. We've been adding to some of those in decent size. It's interesting. Emerging markets where you don't have some of these stresses, the yields are actually really, really attractive, and the supply demand is actually in pretty good shape. So we're trying to balance all those dynamics. Listen, we're buying quality assets. I talked about it on your show last month. We're buying things like in the front end of the yield curve, commercial paper at 6%. I mean, these are crazy levels. So, it's where do you want to spend your dollars today? Take some really short end of the curve interest rate exposure because the curve's so inverted, but then start to layer in things like agency mortgages, some investment grade credit to get a bit more interest rate exposure. So quite frankly, it's one of the most fun markets that I've been in a long time because there's so many dynamic changes taking place today.
So, Rick, I feel like I've been on this journey with you over the last few years. In fact, it's been longer than that. It's been much of the last decade. But over the last 12 months, I just want to talk about one way we've measured that, your risk appetite. One way we've gauged that is by your cash allocation. Rick, can you tell me what that's been doing, up or down, what that's looked like from 1 month to the next?
Yeah, so I mean, it depends what you call cash. So it's come down a lot. And it's come down a lot because we're putting so much in these front-end yields now. It depends on this commercial paper cash. It's cash-like because it rolls off in 2 to 8 months or so. So we've been putting a lot of money to work, particularly in these front-end cash-like investments that are, what they do, the big challenge you have in fixed income today is if I give up some of my cash holdings like commercial paper, I'm going to give up yield to go longer on the yield curve. That's not something people are generally used to who manage fixed income. So yes, we've definitely put money to work. We're neutral in equities. I think the technicals are pretty good. The price too high from multiple point of view. So we're pretty neutral on equities. We've been buying some defensive equities, things like defense, healthcare, parts of tech, staples, but putting some money to work in equities, pretty neutral today where we were short for a long while.
Rick, just to build on that, if you do take, say, something with a maturity of 6 months, in 6 months you've got to make another decision what you do with that money again. Can you talk to me about the potential for reinvestment risk if we do indeed get a complete reevaluation of Fed policy going through from here and they do start to cut interest rates aggressively?
So, John, that's the balance that we're undergoing today, and part of why we pushed some of our exposures further out the curve, including in the last week, is to lock in. And we got the 10-year note back to 375 last week, and it's not that exciting when you get the 10-year now under 340. So we are starting to term out some of this. By the way, the belly of the curve, sort of the 3 to 5 year point. Some of it through credit, some of it through mortgages, where we are pushing it out a little bit. But like I say, we're going to go through. You started with the debt ceiling. Like, how much risk do you need to take today when we're going to get chances to buy assets that have risk to them? So there's a balance of how much do you want to hold and just carry really well. We're trying to carry over 6% in our fixed income portfolios. You can get that by buying commercial paper. So that's the balance we're trying to manage today.
Rick, I know you've got to run. I just wanted to finish on this. Congratulations to you for becoming Morningstar's Outstanding Portfolio Manager of 2023. I will say it's early days of 2023, Rick, and you'd be the first one to say that it's not just about you, it's about a team as well. Just a comment on that, if you will, Rick. What have you and the team been doing that's led to this?
So, I don't think they give it to us for performance for the first 3 months, which has just been okay. But I think the critical thing, I think, for investing in the last 2 years, Jonathan, and kind enough to have me on your show for so many months, is the regime shifts. We've gone through, last year we probably went through 4 or 5 different regimes. I think we've gone through 3 regimes this year. Is trying to anticipate, and like you say, I use a lot of data, use AI now, use your research around the world to try and think through what is the next regime, trying to avoid some of the noise. We live in a world now that, like, social media, it's like the theme of the day. And you got to be careful about, don't overemphasize the theme of the day, but think about what the structural influences are in the economy and then try and get positioned for that.
Hey, Rick, awesome as always. Congratulations. Rick Reeder of BlackRock. We'll continue this conversation, buddy. Looking ahead to payrolls next week and a Federal Reserve decision. Your equity market focused on one thing. First Republic negative by more than 20%. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
DOJ or other authorities
could face bigger challenges next.
was going to keep rain World Cup. This is a 3.
As the economic picture does.
Is it the okay is getting ready to make
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwist, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown. and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed Harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
so in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as you're going to describe about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We got a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the Garden City feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20–25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
You need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's a reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。
不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her